The world's economies are closely intertwined. Events in one corner of the globe can ripple outward, impacting businesses, markets, and individuals far away. Understanding these global economic trends is crucial for investors, policymakers, and anyone seeking to navigate today's complex financial landscape. From the Federal Reserve's interest rate decisions to geopolitical tensions in the Middle East, a multitude of factors are shaping the global economic outlook. One of the most significant developments in recent times has been the Federal Reserve's aggressive campaign to combat inflation. By raising interest rates, the Fed aims to cool down the economy and bring inflation under control. However, this policy tightening has global implications, as higher interest rates in the United States can lead to capital flight from emerging markets and a stronger US dollar, which can make it more expensive for countries to service their dollar-denominated debts. Meanwhile, the ongoing conflict in the Middle East has sent shockwaves through global energy markets. Oil prices, a key driver of inflation, have been particularly volatile, adding to the uncertainty surrounding the global economic outlook. The conflict has also highlighted the interconnectedness of global supply chains, as disruptions to energy supplies can have far-reaching consequences for businesses and consumers around the world. In this complex and rapidly evolving environment, understanding the key drivers of global economic trends is more important than ever. By staying informed about the latest developments and their potential implications, we can better navigate the challenges and opportunities that lie ahead. The US Federal Reserve is facing a delicate balancing act. Its goal is to curb inflation without triggering a recession. The Fed's primary tool for achieving this is interest rates. By raising rates, the Fed makes borrowing more expensive for businesses and consumers, which can slow down economic activity and, in turn, inflation. However, raising rates too aggressively risks pushing the economy into a recession. This is a concern that the Fed is acutely aware of as it navigates the current economic climate. Recent economic data has suggested that inflation may be easing, giving the Fed some breathing room. Despite this positive development, Fed officials remain cautious. They have signaled that further interest rate hikes may be necessary to ensure that inflation is brought fully under control. This cautious stance reflects the Fed's understanding that the fight against inflation is not over, and that premature easing of monetary policy could undermine the progress made so far. The Fed's decisions have global implications. Higher interest rates in the US can attract foreign investment, strengthening the dollar. While a strong dollar can benefit American consumers by making imports cheaper, it can also make US exports less competitive and hurt the economies of emerging markets that rely on dollar-denominated debt. The Fed's balancing act is being closely watched by the world. Geopolitical tensions, particularly in the Middle East, are having a profound impact on global oil prices. The Middle East is home to some of the world's largest oil reserves, and any instability in the region can send shockwaves through global energy markets. Recent conflicts have disrupted supply chains, leading to price volatility and uncertainty in the global economy. The price of oil is a critical factor in determining the rate of inflation. When oil prices rise, the cost of transportation, manufacturing, and production increases, which ultimately translates to higher prices for consumers. This inflationary pressure is felt globally, particularly in countries that are heavily reliant on oil imports. The current situation highlights the need for energy security and diversification. Countries around the world are exploring alternative energy sources and reducing their reliance on fossil fuels. This shift towards renewable energy is not only driven by environmental concerns, but also by the need to mitigate the economic risks associated with geopolitical instability in oil-producing regions. The volatility in oil prices serves as a reminder of the interconnectedness of the global economy and the importance of addressing geopolitical challenges through diplomacy and cooperation. Finding peaceful solutions to conflicts and promoting stability in volatile regions is essential for ensuring global energy security and fostering sustainable economic growth. Section 4. China's economic boost. China, the world's second-largest economy, has recently announced a new fiscal stimulus package aimed at bolstering its slowing economy. This package includes a range of measures, such as increased infrastructure spending, tax cuts for businesses, and financial assistance to struggling sectors. The move comes as China grapples with a number of economic challenges, including a property market downturn, weak consumer spending, and slowing global demand for Chinese exports. The Chinese government is hoping that this stimulus package will help to revive economic growth and restore confidence in the country's economic outlook. Infrastructure investments, in particular, are seen as a key driver of economic activity and job creation. By injecting money into these projects, the government aims to create a ripple effect throughout the economy, boosting demand and encouraging private sector investment. However, the effectiveness of this stimulus package remains to be seen. Some analysts argue that the measures may not be sufficient to offset the headwinds facing the Chinese economy, while others are concerned about the potential for these measures to exacerbate existing problems such as high levels of debt. The success of China's economic boost will have significant implications for the global economy. A strong recovery in China would provide a much-needed boost to global growth, while a continued slowdown would have negative spillover effects on other countries, particularly those that are heavily reliant on trade with China. Section 5. Europe's inflation dilemma. The European Central Bank faces a challenging economic landscape. Inflation, while easing, remains stubbornly high in many parts of the Eurozone. The ECB's primary mandate is to maintain price stability, which it aims to achieve through its monetary policy tools, primarily interest rates. Raising interest rates can help to curb inflation by making borrowing more expensive and cooling down economic activity. However, the Eurozone is also grappling with weak economic growth, and raising rates too aggressively could stifle this already fragile recovery. This presents a difficult dilemma for the ECB as it attempts to strike a delicate balance between taming inflation and supporting economic growth. Adding to the complexity of the situation is the fact that the Eurozone is not a homogeneous economic bloc. Different countries within the Eurozone are experiencing varying levels of inflation and economic growth. This makes it difficult for the ECB to implement a one-size-fits-all monetary policy that effectively addresses the needs of all member states. The ECB's policy decisions will have significant implications for the global economy. The Eurozone is a major player in the global trade and financial system, and any significant economic developments in the region can have spillover effects on other countries. The ECB's efforts to navigate this challenging economic environment will be closely watched by policymakers and investors around the world. Section 6. Global risks and interconnections. The International Monetary Fund has issued warnings about a number of risks to the global economic outlook. These risks include rising protectionism, high debt levels in emerging markets, and geopolitical fragmentation. The IMF has stressed the importance of international cooperation and coordinated policy action to address these challenges. Protectionist policies, such as tariffs and trade barriers, can disrupt global trade flows, reduce economic efficiency, and lead to higher prices for consumers. High debt levels in emerging markets make these economies vulnerable to sudden shifts in investor sentiment or global interest rates. Geopolitical fragmentation, characterized by increased tensions and mistrust between nations, can undermine global cooperation and hinder efforts to address shared challenges. The interconnected nature of the global economy means that these risks are not isolated. Problems in one part of the world can quickly spread to others, as seen with the recent pandemic and the ongoing energy crisis. This interconnectedness underscores the need for global solutions to global problems. Addressing these challenges requires a coordinated global response. International institutions like the IMF and the World Bank play a crucial role in fostering cooperation, providing financial assistance to countries in need, and promoting sound economic policies. The global economy is at a critical juncture. By understanding the interconnected nature of the challenges we face and working together to find solutions, we can create a more stable, prosperous, and sustainable future for all.